76% of Americans live paycheck to paycheck. Is that you? I'm the CEO of 5 different companies. I wasn't born into it. We lived on welfare, but I wanted more. I created this show, The School of Wealth, helping people escape poverty like I did. I want to help you out of that consumer debt.
This is Brother Kim Carter. We just want to say thank you for reaching out to us, meeting our concerns and what we need to do. And I know you guys working hard on your side for the Carters, and that we are looking forward to be financially free.
Teach you how to increase your credit score. Teach you how to make more money at your current job or your current business. And then how to actually create generational wealth without changing your lifestyle. It is going to be a lot of fun. This is not like regular school. Hey, I'm Rondi Lambeth, and this is the School of Wealth. Well, hello there. How you doing? Man, am I having a busy day. It's 4 o'clock. Have not had anything to eat today. I got up, went to the cardiologist, got my heart checked out, got my CPAP machine worked on, got an oil change, got my truck back from the shop. Been a busy day. I just got home 10 minutes ago. Been gone all day. So I'm super excited to be here to talk about probably one of my favorite things to talk about, and that is tax planning. See, I learned at a very young age when I left home at 15 years old, and I went, one of my very first jobs I ever had was working at a funeral home as a teenager. And I worked for Wally Williams, very wealthy man, multimillionaire, one of the richest men in that city where I lived, very wealthy man. And he taught me something, and it doesn't matter how much money you make. It matters how much money you keep. So think about that. Doesn't matter if you make $1 million and you spend $1 million, you're worse off than someone who makes $30,000 a year and spends $30,000 because you have bigger problems. So it doesn't matter how much money you make. It matters how much money you keep. And the biggest expense in our lives for most people, 50% of Americans, the biggest expense is taxes. Now, why do I say 50% of Americans? Because 50% of Americans don't pay tax. And I'm one of the 50%. Just let you know. Last year, I paid $157. Millions of dollars in revenue, $157. That's it. So how can I have millions of dollars of revenue and income and pay $157? Well, I'm going to share with you today how I've done that and how I've done it now really for 30 plus years, and how I've helped dozens of clients over the last, I started doing this as a income, as a job now, not as a job, as a service in May. So almost, it's been, I don't know, it's now February. So 9 months I've been doing this. So I've helped a couple dozen people go through this structure to where they can now bring in millions of dollars a year in revenue and pay no income tax or little income tax. And in my life, I probably paid $10,000, maybe $10,000 total in my life. I'm 53 years old. You know, my best year ever was $10 million. And I paid $10,000 total in personal income tax. And I'm going to share with you how you can do the same thing. Now, just to be clear, this is not the sovereign citizenship movement that pops up every once in a while. I see it. I know a guy that I've known now for over a decade, a chiropractor, that he's on this sovereign citizenship movement. And eventually the government will come knock on his door and throw him in jail. Even though it's legal, it's 100% legal what he's doing. It's like the movie The Matrix. You have a choice. You can take the red pill or the blue pill. If you take the red pill, you see the matrix and how far it goes. And you can opt out of the matrix. Freedom is not free, guys. You give up a lot to be free. So if you want to be a sovereign citizen, it's like living in the matrix, hiding in the sewers, eating the porridge, putting the blade, the big old knife in the back of your head, wearing crappy clothes, hiding from sentinels, which are IRS agents. You can do that. Or you can live in the matrix, but not be part of the matrix. Remember the scene in the Matrix where the kid says to Neo, don't try to bend the spoon. No, there is no spoon. And if you understand the Uniform Commercial Code along with the Internal Revenue Code, just the basics, you don't have to become a corporate attorney or a tax attorney, just the basics, then you can learn how real business is done in the world. And you'll learn that the UCC, Uniform Commercial Code, is the most powerful law in the world. It dictates everything we do. So if you are using a Federal Reserve note, which is debt, by the way, also known as a dollar bill, $100 bill, $20 bill, that's a note, that is debt. The holder, so if you have a $5 bill in your pocket or in your hand, the US government owes you $5 of silver or gold. So that $5 bill is a Federal Reserve note. It is debt. So when you use debt to pay other debt, you're not ever really paying off debt. You're discharging the debt. But if you're using the Federal Reserve note, the dollar bill, regardless of the denomination, you're using UCC, Uniform Commercial Code. You're agreeing to UCC, whether you know it or not. So if you can understand the basics of UCC and the basics of the Internal Revenue Code, you can earn millions of dollars a year and pay no income tax. This is how Bezos does it. This is how Elon Musk does it. This is how every single Fortune 500 company does it. This is how every publicly traded company does it. And now I'm going to show you how you can do it. So let me bring up this here. You guys see that okay? Now, if you have any questions whatsoever, any questions at all, feel free to start typing them in the chat and I'll get to them all. So what this represents is this is the world right here. This is the world. You're doing business with the world. You have customers, for example. And this is how most people have their entity set up. They have customers that pay them dollar bills, cash, and it goes into your LLC, sole prop, S Corp, C Corp, whatever you have. And then you have all your deductions, your cars and your dinners and your trips. So, you bring in $1 million of revenue, comes in here, and then you do your best to write off things. And at the end of the year, CPA pats you on the back and says, great job, Johnny. You owe the IRS $300,000 because you made $1 million. And then what happens is this money just flows over to your social slave, to you. And then you take that hard-earned money and you transfer it up to the IRS. That's how most businesses work. The world, through customers, pays them cash, goes into your LLC, S Corp, or whatever's left over after your deductions goes to you. You get your standard deduction, your 401k, your IRA, your HSA, and then you're left, and all that money goes up here. And then you're going to pay approximately 10 to 37% federal, depending on how much money you make. That's the range, 10 to 37%. And then the state is 5 on average. State tax is 5%, all the way up to 13.3. So if you live in California, you're paying 13.3. If you live in Idaho like me, you pay 5%. If you're living in Florida, you don't pay anything in state income tax. Businesses pay taxes, and there's only one state, by the way, one state left that is no taxes on business, just one, and that's Wyoming, because Nevada is now charging income tax on businesses. They're going the opposite way. See, Nevada used to have no sales tax, no property tax, no income tax. Now they have a high sales tax, high property tax, and now they have income tax for businesses. No personal yet, but I think that's probably coming because they have maybe not. They're starting to, they went really blue for a while. So if they go back red like Florida, maybe they'll go back to no taxes. But anyway, so 5 to 13%. And then the one that people don't realize, the one they don't think about, is self-employment tax. That's 15.3%. Now, if you're an employee, your employer pays half of that. But if you are the employer and you're self-employed, then this guy right here rolls it over to you and you pay 15.3%, plus unemployment insurance, plus workman's comp. It is a nasty tax, and you pay up to $24,000 because after 160 grand, you don't have to pay the self-employment tax. And this is why people say, hey, make your LLC an S Corp so you don't have to pay the 15.3% tax. Well, the problem with that is you lose the qualified business income on your salary. So if your salary is 100 grand, that's a $20,000 cost per year to have that LLC, because you just lost $20,000 of immediate tax write-off. So the cost is actually less than 20 grand, but you lose that $20,000 write-off, 20%, because of your reasonable salary. So this is what most people have. Here's the business, the money comes in, goes to your business here. You pay, you try to reduce your taxes, buy new cars, etc. Whatever's left over goes here, and then you pay your hard-earned money. If you live in California, you're paying as much as 65% tax. And then the money's left over, then you pay sales tax, property tax, gas tax, cell phone tax, utility tax, on and on and on. So we want to limit the personal income tax, and here's how we do it. We set it up something like this. Pretty straightforward. Here's your customers. They pay your working LLC. The profits are transferred out of this LLC, which is based in Wyoming, so there is no state income tax, there is no self-employment tax, and there is no federal income tax. That money transfers up to this LLC. This LLC has its own set of deductions. Also, this LLC pays no state tax, no federal tax, no state self-employment tax. Then you pull enough money via a contract out of your holding LLC to your state sole proprietorship, not your S Corp, not your LLC, just a S sole proprietorship. So say you need $100,000 a year, you pull it out via contract, you get a 1099. And then you do all your deductions, and you notice there's no money going to the IRS from your social slave because you control how much money comes out of this company. See, when you have this, there's no control. If this company profited $100,000, that profit goes right here, goes right on you. You have no control of that. But in this structure, because of this contract, you can choose how much money you pull out, which is just enough to pay for your flesh, just enough to pay for groceries, just enough to pay for your mortgage. Therefore, there is no taxes coming from you. Instead, the profits go up to your C Corp that owns 98% of your holding company. And because the C Corp owns 98% of it, 98% of the tax owed goes up here. And then you're taxed at 21%. Top tax, 21%. No FICA, so you save 15.3%. No state income tax, so you save up to 13%. You simply pay a flat rate of 21%, which is generally half of what you will pay with this type of structure. And this is what your CPA's got you set up like. So you can add a couple little moves in here and save 50% day one. So instead of giving the IRS $100,000 a year, maybe you only give them $20,000 a year or nothing at all. And then if your business is really booming, then you can go over and do something like this. Really limits your tax. In fact, with this structure right here, you could make $100 million in revenue, $100 million in profit, and pay no income tax at all. No corporate, no federal, no state, no. no self-employment tax, no tax whatsoever on this type of structure if set up properly. So if you're a business owner and you have profit, you're a profitable business owner, and you'd like me to sit down with you and show you how you could actually do something like this to cut your taxes in half, then go to my website, rondilambeth.com, just like my name, rondilambeth.com, and sign up for a free consult. And I'll sit down with you and I'll show you exactly how this works to get you out of this game that your CPA has you in. This is the max tax. This is what the IRS loves this. Now, a lot of people ask, well, does this increase the likelihood of being audited? No, in fact, it actually does the opposite. See, this type of structure, your standard S Corp LLC, 1 out of every 100 will be audited. 1 out of every 100. So 1% chance you'll be audited with this structure. This structure, 0.0004% chance of being audited. 0.0004 versus 1% in this structure. So it lowers the likelihood of being audited. It protects your assets. If you got sued, say one of your customers sued you, they can't garnish you. They can't levy you. They can't take any of your assets. They can't take anything from you. All they can do is put a lien on your company, this company here. Who cares? That company doesn't have any assets. All the assets are up here. And this company's never done business with the world. So that lawsuit cannot take money from this company, this guy, or this guy. They can only come after this one. And they can't take anything. They can just put a lien on it because it's in Wyoming. And Wyoming's a non-charging state, non-reporting, non-charging, non-tax. It is the greatest state in America to incorporate it. It is so much better than these offshore Bahama trusts and LLCs that cost 50 grand a year just to maintain. This is the structure you want. And then you can make it a little more complicated like this if you want to. That's what I want to share. So let's open it up for Q&A. Let's do it. We got some people on here. What are some of your questions regarding taxes or business credit or business funding or personal credit or getting out of debt or getting more debt? What do you guys got for me? Because I'm here to help you. And if I don't have any questions, I don't know what you need. So I'll wait here a little while. I know we are streaming on YouTube, on a couple different Facebook pages. So sometimes it takes a little long, it's a little delay if you ask me a question on YouTube or Facebook or LinkedIn or one of the other spots. It takes a little time for it to show up. But so what can you write off? Well, while I'm waiting for these, when it comes to taxes, anything can be a deduction for you. Anything, as long as it's reasonable and necessary for your business. So, what can be deducted? Anything. Literally anything. It just depends on your business. So, if you are I'm just looking at myself in the camera here. I got these glasses on. If I was somebody trying to sell glasses on YouTube or Amazon, then I could write off glasses. It's inventory. If I was a guy trying to sell watches, watch trading, I could buy watches and that's a tax deduction. If I have a clothing store, this could be a deduction. Now, is this shirt that I got a couple weeks ago in Coeur d'Alene, where I met my beautiful girlfriend, which is why I got this nice little jacket here. Is this tax deductible on its own? No, this is not a business thing. But if I own if it said Fortress here or M25 or Credit Mojo or any of my other companies, then that would be a uniform and that's deductible. But because it says Coeur d'Alene, that's not a deduction unless I had a clothing store and I was selling these Coeur d'Alene sweatshirts. Okay. So here's some questions. So pull this one up. What's the process of going from a sole prop to an LLC? The process is pretty straightforward. You would go to your Secretary of State. So I prefer to set everything up in Wyoming unless it has to be in the state you live. So if you're actually doing business in the state, so if it's Garrison Auto Solutions and you're doing stuff in your state, then you would go to your state secretary So this is your state's state secretary, secretaryofstate.com. So Wyoming.secretary of state, Idaho Secretary of State, California Secretary of State, and you would incorporate. And so when you incorporate, it's like giving birth. You're giving birth to your company. I don't know what it costs anywhere outside of Wyoming. It's $103 to incorporate in Wyoming, and then $25 a year for your registered agent in Wyoming, because you need somebody to be available to receive mail. So it's $25 a year, not a lot. So the way you go from a sole prop to an LLC is you go to your Secretary of State's website, you pay the state's fee, and you register the name, and then you get your paperwork from the state, and then you need to create articles of incorporation. You need to have your bylaws, also known as an operating agreement. You need to have your minutes, and then all of your contracts that you would have under that company. Then you need to go to irs.gov and apply for an EIN number. You don't need to pay someone to do this. It's super easy to get your EIN. And then you get your EIN, you can go down to a bank and you show them your operating agreement along with your EIN, and you open a bank account. And now you're an LLC. Now, LLCs, just to be clear to everybody, LLCs provide no tax savings. Zero. Nothing. LLCs provide no tax benefits. It's strictly asset protection. It's only because as a sole proprietor, you get the same tax benefits, tax reduction benefits, as a LLC or even a corporation in most cases, as just a sole proprietor. The difference between the sole proprietor and the LLC is now you have a little layer of asset protection. But if you set it up like this, it's just you. So if you get sued, they're going to take all your stuff out of the company because it's just you over there. Or if your company gets sued, they're going to come after you and your house because it's just you. So when you set them up, you always want them to have at least 3 members. 3-member LLCs minimum as far as asset protection goes. Okay. I have an EIN for the sole prop. Do you need a different one? Yes. So once you incorporate, you're going to get a new EIN number. So you go to irs.gov, and it's, instead of doing start a new business, it's changed the business. It's technically you're starting a new business because the LLC is now a business where the sole prop was just you. So you would get a new EIN number. Because sole props have different numbers than corps, and corps have different numbers than LLCs, and then partnerships have different numbers. So yes. Trace says, my wife and I make $287,000 combined. What's the best way to decrease tax liability? We both have jobs, no business currently. So there's not a lot you can do, my friend, outside of starting a business. You have your 401k, you have your IRA, you have your HSA. You could also start a family foundation, which is a nonprofit family organization, and you could deduct 30% of your income. So you could take almost $90,000 from your paychecks and put into your family foundation as a tax deduction. So now you're only paying taxes on $187,000. And one of the rules is you have to give away at least 5% of what you collect every year. So if you put 90 grand in there from your salary, you would have to donate to your favorite charity or to a charity, $4,500. So instead of paying taxes on 90 grand, you give $4,500 to your favorite charity. So that's one strategy. Now, who does stuff like this? Well, I hate to say their names, but the Clintons, they got multi-billion-dollar foundation, and then they run these NGOs, and this is what Elon is discovering through Doge, is they're finding that the government, our politicians, were setting up NGOs, non-government organizations, and then funneling money from the U.S. taxpayers to their own NGO, to their own personal foundation. Clintons did this. This is how they paid for Chelsea's wedding, how they paid for a $10 million house. They took taxpayer money and funneled it through an NGO and then gave it to their daughter. The Bidens do it, the Obamas do it, the Bushes did it, the Reagan, they all do it, except for the guys that are in there now exposing it. So that's about the only thing you could do outside of starting a business. Now, if you started a business, in the business I would start if I was you, so I'm going to pull this back up, Trey. What else you can do is if you get a short-term rental, so you go buy a condo or a house and you do Airbnb for a maximum of 7-day rentals. So you don't let someone stay in there for 30 days. These are short-term, 7 days at a time. And you manage it personally. There is a clause, it's not a loophole because it's actually written in stone, if you will, in black and white, that says if you manage your own short-term rental, remember I say this, if you do what the government wants you to do, they reward you with tax savings. So what the government wants people to do is start buying real estate and providing short-term rentals because the county, the state, and the city gets their tax. They get their flesh. And so if you do it on your own, you manage your short-term rental on your own, you qualify now as a real estate professional. Even though you didn't spend 750 hours as normally required. So in order to be a real estate professional, you got to do 750 hours, unless you do short-term rentals. So Trey, what I would do if I was you is I would go buy a short-term rental. And even if you broke even, because here's what happens. Let's say you go buy a $500,000 single family home and the land's worth $100,000, but the house is worth $400,000 because the land never depreciates. You can take that $400,000 and essentially, it's not quite this math, but essentially you take the $400,000, divide it by 5. So that's $80,000 a year deduction. So now you and your wife, through that one short-term rental, is going to receive $80,000 write-off, which in your tax bracket is going to save you about $35,000, $3,000 a month. So think about that. You could literally buy a $500,000 house and pay for it with the tax savings. And then the money you make from it is additional income. And then you take next year, you buy another one and another one and another one. And just by saving the money on the taxes, it pays for your real estate portfolio. And after a while, you'll have so much money coming in from your short-term rental business. Maybe you quit one of your jobs. So that's how you do it. That's really about the only way. Private foundation, or you start a business, and a good business to offset W-2 income. And the only way to offset W-2 income is short-term rentals. Heidi, how can I find a tax professional? I'm in the Denver area. Well, what are you looking for in a tax professional? Because I'm a tax professional. I'm a tax strategist. I don't file taxes, but I come up with tax plans. Primarily, not if you're just W-2 and you make $100,000 a year. There's not a lot you can do other than what I just said. But if you're a business owner and you make over $100,000 a year, I can save you significant money. And how you would book a call with me is just rondilambeth.com. So otherwise, you can go, if you're a W-2 employee and you're just looking for someone to help you out a little bit, Tom Wheelwright, Robert Kiyosaki's tax professional. It's got a whole bunch of people in Denver. A Tax Hive is another one. Or Chastity, if you could put up my Jake's link. So I think it's rondilambeth.com/CPA, or it's Fortress Credit Pro. I'm not sure, Chastity, how you did that, but it's the link for the tax professional with Jake Alexander. So he can help. That's somebody who's going to file your taxes. They don't set up structures and stuff like me. They simply just file it. And that's what most tax professionals do, is they're tax filers. They don't really save you much money. In fact, when you go to rondilambeth.com, you'll see a little link there to a Forbes article in Forbes magazine discovered that 93% of business owners in America pay more than they're legally required to pay in tax. 93%, regardless of their CPA. So fortressu.com/tax. That's a good way to find them. I was just looking to see if I got some more questions, and I don't on there. So let's look over here. Hey, Tommy. Good evening, Mr. Tommy. Tommy says, good evening. Good evening to you, Tommy. Hope you're doing well. Anything else, guys? Any other tax questions, business credit questions, funding questions, debt reduction programs? I'd love to help you some more. I don't need to sit here and just flap my lips. All right. Well, I don't see any more questions, so you guys are pretty quiet. So I'm going to go ahead and call this a wrap then. If you guys make over $100,000 a year and you're a business owner and you want a free tax consultation to save you substantial money, you can go to my website, rondilambeth.com, and just sign up for a consult there. And I'll sit down with you and go over your current corporate structure and show you how you can save a lot of money. And again, my average client saves over 50 grand a year in taxes, but it's generally, I'm going to save you at least 50%. Oh, I got a question on Slack. So let me see. Somebody asked, what do I think about Doge refunds we may be getting? I think we're going to get them. I really do. I think we're going to get the Doge refunds. It depends on how much money they save us, but let's say that they save us $1 trillion and we get 20% of that as a refund. What is that? That would be what? $200 million? Yeah, $200 million. Is that right? Let me do the math real quick. If we have 1 trillion, we get 20%. That's $200 million. Divided by 300 million. Yeah, I think it's not going to oh, no, that's not right. It's 300 billion, 200 billion. My math was wrong. I'm sorry, guys. It's $200 billion. 200 billion. I'll turn my calculator this way. 200 billion divided by 300 million Americans. $1,000, roughly $600. So if they save a trillion, we'll all get $1,000 back, something like that, somewhere there. So that's better than not getting anything. I don't think the government's ever refunded tax stuff. So I think it'd be cool if Doge could work that out. Hope another question's coming in. We'll see what it is, and then we'll probably wrap it up. Nope. I guess I saw the little bubbles like someone was typing, but then it went away. So, oh, here it comes again. There's some bubbles. We'll see. Again, if you want a consult on your tax structure, your business structure for asset protection, legacy preservation, and tax reduction, just rondilambeth.com. All right, guys, let's call this a wrap. I hope you all have a wonderful day, and I will see you next month, next Thursday, the first Thursday of March. I'll see you then. Bye for now.